Imagine it's 6th of October 2008. You are a 34-year-old schoolteacher living in Reykjavik, Iceland. You share a small apartment with your husband and your 6-year-old son, and on the kitchen shelf there is a neat stack of bills, a half-empty jar of instant coffee, and a little envelope where you keep the family emergency cash. Your savings are in Landsbanki, your car loan is linked to inflation, and your mortgage payment already feels like a weight tied to your ankle every month. In the morning you walk past tidy shops, fishing boats in the harbour, and glass office buildings that seem to rise out of nowhere in the boom years, bright as mirrors, confident as kings. People around you have been told that Iceland is modern, rich, clever, different, that this tiny island somehow found a way to turn itself into a financial power. At school, the children still draw volcanoes and sheep and little red-roofed houses because to them the world feels solid and permanent, like snow packed hard enough to hold your weight. If you have ever wondered why some countries seem to collapse, then recover, while others spend a decade paying for mistakes they did not make, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before, and once you see it, you cannot unsee it. If you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. That afternoon, the floor starts to move. Parliament passes an emergency law. Within days, Glitnir, Landsbanki and Kaupthing, the 3 giants that had towered over the whole economy, are gone. The money is not gone in the simple way people imagine. The lights stay on. The cards still work at home. But the illusion breaks. And once an illusion breaks, it makes a sound louder than glass. The krona falls. Imported food gets more expensive. Fuel gets more expensive. Debt tied to prices gets heavier. Debt tied to foreign currency becomes a trap with the walls moving inward. Outside Iceland, many people expected the country to become a warning from the edge of Europe, a frozen ruin dragged under by reckless banks and then kept there by debt, austerity, and shame. That did not happen. Iceland suffered badly. Output fell. Unemployment rose. Families panicked. Protests filled the streets with the sound of pots and pans. But the country recovered faster than many experts expected. And the reason matters now just as much as it mattered then, because Iceland did not simply reject help. It did something more important. It rejected the most punishing version of the rescue script. It refused to turn every private banking loss into a permanent public sentence. It let foreign creditors take losses. It used capital controls, which means rules that stop money from rushing out of a country all at once like water through a broken dam. It allowed its currency to fall instead of forcing society to fall even harder. That choice did not make the pain disappear. Nothing could do that. But it changed who carried the pain, how long it lasted, and what kind of recovery became possible. Before we go further, there is something important to understand. A banking collapse is not just a story about banks. It is a story about who gets asked to absorb the shock after the music stops. Think of a country as a house built beside the sea. In good years, banks keep adding new rooms, new windows, new borrowed furniture, and everyone starts believing the house is bigger than the land beneath it. Then the storm comes. At that moment, a government has a choice. It can save the walls that face the street so the house still looks impressive from far away, or it can save the people inside. That is the mechanism beneath this whole story. When banks grow huge using foreign money, they create a mismatch, which means the debts are one shape and the country is another. The banks may owe money in dollars, euros, or pounds, while the people who live in the country earn in local currency. In normal times, that mismatch hides in the wallpaper. In a panic, it tears the room apart. If the government guarantees everything, private losses become public debt. Then comes austerity, which means cutting spending and raising taxes to make the books look better. It is like fixing a cracked roof by taking the food out of the kitchen. The house may still stand, but the people inside get weaker. If the country instead lets creditors take losses, restructures debt, protects the payment system at home, and uses capital controls to stop a stampede, the shock hits fast, but the damage can be contained. The currency usually falls. That hurts. Imported goods cost more. But exports become cheaper to the rest of the world. Fish, aluminum, tourism, software, shipping, whatever the country sells suddenly gets a boost. So the real question is not whether a collapse will hurt. It always hurts. The real question is whether the pain is turned into a short violent storm or a long gray winter. This brings us directly to Iceland. By the eve of the crash, Iceland's banking system had swollen from about 100% of GDP in 1998 to roughly 900% of GDP in 2008. The combined assets of the 3 biggest banks were about $155 billion, around 9 times the size of the entire economy. For a small country, that was like a fishing boat trying to carry an ocean liner on its back. The banks had grown through borrowed foreign money, high-interest online deposits, and expansion far beyond what Iceland's state could ever backstop, which means support in an emergency. It looked sophisticated. It looked global. Underneath, it was a tower of ice standing over warm water. When the global financial panic hit in 2008, that tower melted fast. In the first week of October, almost 90% of Iceland's banking sector failed. The krona plunged. One central bank speech later summarized it with brutal clarity. Iceland was not a country that chose to let all banking disappear. It kept the domestic system running, but the oversized cross-border banking empire was too big to save. And this is where the story turns. Many countries in crisis are told some version of the same thing. Protect confidence, honor claims, avoid shocking creditors, tighten the budget, restore trust. In plain English, this often means ordinary people are asked to carry a load built by financiers, ministers, and foreign lenders. Iceland chose a narrower rescue. On 6 October 2008, Parliament passed the Emergency Act. Depositors in Iceland were given priority over other unsecured claims. New domestic banks were created. The old banks were left holding much of the foreign mess. That split matters. It was not a perfect good bank, bad bank solution, but it drew a line around the domestic heart of the economy, like firefighters cutting a trench in a forest to stop a wildfire from reaching the town. The IMF then approved support in November 2008. Iceland did not reject the IMF itself. That is an important detail. The IMF program, together with Nordic loans and support from Poland, brought financing of about $4.4 billion, including $2.1 billion from the IMF. But Iceland resisted something larger than a single institution. It resisted the pressure to make the whole society swallow all the losses of failed private banks, especially in the Icesave dispute with Britain and the Netherlands. That dispute became the moral center of the crisis. Landsbanki had gathered depositors abroad through Icesave accounts. When the bank failed, Britain and the Netherlands compensated their citizens and wanted Iceland to repay them on state terms. Iceland's parliament negotiated. Its president, Ólafur Ragnar Grímsson, refused to sign the first deal. The issue went to referendum. On 6 March 2010, voters rejected the first Icesave deal by 98.1% to 1.9%. A second deal was rejected on 9 April 2011 by 59.77% to 40.23%. In 2013, the EFTA court ruled in Iceland's favor in the core legal case. Those votes were not just about money, they were about a line in the sand. The message was simple. A nation is not a vacuum cleaner for every private financial liability floating toward it. There is also a counterintuitive fact here that many people still miss. Iceland did not simply walk away from everything. It did not default as a sovereign state in the loose dramatic way the myth suggests. Later speeches by Icelandic officials made this point again and again. The domestic banking system was kept running, sovereign obligations were paid. What changed was not whether every promise in society mattered. What changed was which promises the state would treat as sacred after private banks had exploded. That distinction is the whole game. If you blur the line between a country and its banks, then every failed speculation becomes a national moral duty. If you keep that line visible, then some losses stay where they were created. That sounds technical, but it decides whether a nurse, a teacher, or a mechanic spends the next decade paying for a bond trader in another country. The pain at home was still severe. Real GDP and domestic demand fell hard in 2009 and 2010. One IMF review put the cumulative drop in real GDP over those 2 years at 10.5%, while domestic demand fell 23%. The krona lost around half its value against the euro within 12 months. Inflation approached 20% in late 2008. Unemployment, once barely visible by European standards, rose from around 2 to 3% before the crisis to near 8 to 9% in the years after. For ordinary people, this was not abstract. Families with loans linked to inflation watched monthly payments climb like a staircase being built under their feet. People with foreign currency debt were hit even harder as the krona fell. Imported basics cost more. Savings felt less safe. Trust collapsed faster than any index could measure. In January 2009, thousands banged pots and pans outside Parliament in what became known as the kitchenware revolution. The sound was the country telling its rulers that the old story was over. And yet, because Iceland ring-fenced its domestic banking system, let the currency adjust, and used capital controls to stop money rushing out, recovery could begin sooner than many expected. By June 2011, Iceland had returned to international capital markets with a $1 billion bond issue. By 2015, the IMF was describing macroeconomic conditions as the best since the crisis. Output was on track to surpass pre-crisis levels, debt ratios were falling, and tourism and fisheries were driving growth. Not because Iceland escaped pain, because it refused to freeze pain into the foundations of the state. Here is something I want you to think about before we go further. When a country is in free fall, what matters more? Keeping foreign investors calm in the next 24 hours? Or keeping your own society functional for the next 10 years? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of this story. A decade before Iceland, another country had faced the same basic threat from a different angle. Not a North Atlantic island of fish and volcanoes, but Malaysia in the Asian financial crisis of 1997 and 1998. The official script at the time was familiar. Keep markets open, raise rates, restore confidence, accept the pain quickly, let the medicine work. Malaysia under Prime Minister Mahathir Mohamad chose a different path. On 1 September 1998, Malaysia imposed capital controls. In plain English, it put gates on the exits, so speculative money could not stampede out all at once. On 2 September, the ringgit was pegged at 380 to the US dollar, which means the government fixed the exchange rate at that level instead of letting it whip around in panic. This was treated by many outsiders as heresy, which means a forbidden act against the accepted doctrine. It was described as backward, reckless, even desperate. But a Harvard study later comparing Malaysia with countries under IMF-style programs found that Malaysia's policies produced faster economic recovery, smaller declines in employment and real wages, and a more rapid turnaround in the stock market. Malaysia still suffered. Its economy contracted by about 7.4% in 1998. Businesses failed, workers lost jobs, confidence was shaken. But growth returned quickly, rising by roughly 6.1% in 1999. The country did not spend a lost decade proving its obedience to the financial weather. Now here's where it gets interesting. Malaysia and Iceland were not identical. Iceland let its currency fall and used capital controls to manage the wreckage. Malaysia fixed its currency and used controls to buy breathing space. Different tools, different regions, different institutions, but the same deeper idea. In both cases, the government decided that financial openness during a panic was not a sacred principle. It was a trapdoor. That is a deeply uncomfortable lesson for economists who prefer clean rules. Because in textbooks, capital should move freely to its best use. In a panic, though, capital often does not move to its best use. It runs for the exit. It behaves less like a wise investor and more like a crowd in a dark theater after someone smells smoke. And when all money tries to leave at once, even healthy parts of an economy can suffocate. Iceland understood this in late 2008. Without controls, the krona might have collapsed even further. Firms with foreign currency debt would have been crushed. Households with price-linked loans would have been hit harder. Reserves were too thin to defend every exit. No interest rate, not even a punishingly high one, could guarantee stability under those conditions. So the country did something many richer and larger states did not dare to do. It said, "We will not preserve the illusion of total openness at the exact moment openness becomes self-destruction." That choice also gave Iceland time to do something that matters in every recovery but gets less attention because it is slower and less dramatic: debt restructuring. The new banks took loans at large discounts, which gave them room to write down or renegotiate debt instead of pretending every bad loan was still healthy. In other crises, banks often keep dead loans alive to avoid admitting losses. Economists call these zombie firms, which means companies that are not really alive but somehow never quite die. They sit in the economy like fallen trees across a road, blocking movement for everyone else. Iceland cleared more of that road than many people realize, and that matters because recovery is not just about restarting growth. It is about deciding whether the future will be built on cleaned wreckage or hidden rot. Look at what happened next. For comparison, consider Latvia after 2008. Latvia did not choose devaluation. It kept its currency peg and pursued what was called internal devaluation, which means lowering costs inside the country through wage cuts, spending cuts, and a brutal squeeze instead of letting the currency fall. Between late 2007 and late 2009, Latvia's GDP fell by about 25%. Unemployment rose from around 6% to more than 21% by early 2010. Public wages were cut sharply. Emigration surged. The economy later recovered, yes, but the social price was enormous. So when people say every country simply has to take the pain, the right question is this: which pain, for whom, and for how long? Because that answer is never neutral. Now observe what all of these cases have in common. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for. The part they never put in textbooks. The same mechanism, different countries, different decades, same result. When a crisis begins, leaders often talk as if confidence were a delicate bird that will fly away forever if creditors are not reassured immediately. But history shows confidence is not a bird, it is a shadow. It follows real conditions. If your economy is crushed for years to protect balance sheets on paper, confidence does not return because a minister gives a speech. It returns when people can work, pay, buy, sell, and plan again. Now look at Iceland, Malaysia, and Latvia together. Iceland drew a line around the domestic economy, accepted currency pain, used capital controls, and forced more losses onto creditors. Malaysia used capital controls and policy space to halt panic and recover faster than many critics expected. Latvia defended its peg and regained competitiveness through internal cuts, but at the cost of a collapse so deep it felt like the country had been asked to breathe through a straw after running a marathon. Different institutions, different politics, same fork in the road. Do you absorb the shock through exchange rates, creditor losses, and temporary controls? Or do you absorb it through unemployment, wage compression, and years of public strain? That is the pattern, and once you see it, many famous crises start to look less like natural disasters and more like decisions about distribution, which means decisions about who pays. This is where Greece enters the frame. In 2010, Greece became the symbol of the Eurozone debt crisis. The country could not devalue because it did not control its own currency. It used the euro. That matters more than many people realize. A country without its own currency in a crisis is like a patient without access to one of his own lungs. He can still survive, but every breath depends on someone else. The IMF's own later evaluation was striking. Real GDP in 2012 was 17% lower than in 2009, far worse than the original program forecast of a 5.5% decline. Unemployment reached 25% in 2012 versus an original projection of 15%. Broader summaries put the overall collapse at about 25% from 2010 levels, with unemployment peaking near 27%. Wages fell, pensions fell, businesses died, young people left, public anger exploded, and one of the most damning parts of the story was debt restructuring. It was delayed. Private creditors had more time to reduce exposure. The burden shifted further toward official institutions in Greek society. Even the IMF later acknowledged that ex-ante debt restructuring, which means restructuring early before the full burden hardens, had been considered and ruled out. In plain English, the house was on fire, but some of the people with the hoses spent precious time arguing about whether smoke would upset the neighbors. This is not to say Greece could have copied Iceland exactly. It could not. Different currency system, different political constraints, different treaties. But the comparison still matters because it shows how much policy space shapes human outcomes. Iceland had policy space, Greece had much less, and this is where history gets uncomfortable. People often think recovery speed is a reward for virtue. It is not. Often it is a function of who was allowed to take losses quickly, what tools a state still controlled, and whether leaders protected the flow of domestic life before they protected the reputation of the financial system. In Iceland, the payment system survived. The domestic banks were rebuilt. The currency fell and exports gained. Tourism boomed in the following years. Fisheries remained strong. Debt workouts, while messy and incomplete, moved. Public anger changed politics. The old story died. In Greece, the adjustment dragged through society like barbed wire through cloth. At this point, the pattern becomes impossible to ignore. The people who suffer most in these episodes are usually not the architects of the boom. They are the families with wages in local currency and debts tied to inflation or foreign money. They are pensioners living on fixed incomes while prices climb. They are small business owners who need working credit, which means the short-term money that keeps a shop alive between paying suppliers and serving customers. They are young workers whose first step into adult life happens during a collapse, when every door seems to open into another locked room. In Iceland, middle-class households were hit by mortgage shocks and higher import prices. The country's currency fall made foreign travel, imported food, and many consumer goods more expensive almost overnight. If you had borrowed in foreign currency without earning foreign currency, the ground moved under you. One study of the crisis noted that 13% of households had foreign-denominated debt. When the krona depreciated by roughly 48% from 2007 to 2009, those households were hit like people standing closest to the blast. But Iceland also contained some of the damage in ways that mattered. Domestic depositors were protected. The welfare state was not dismantled to the bone. By 2015, the IMF could say the recovery had been achieved without compromising Iceland's welfare model. That line is easy to miss, but it is one of the most important in the whole story. Because many crisis programs claim to save a country while quietly hollowing out the society that made the country worth saving. Look across the sea to Greece, and you see a harsher version of the same human map. The private sector sustained enormous job losses. The IMF later noted that the burden of adjustment was not shared evenly. High-income tax evasion remained hard to control. State enterprises remained generously staffed. Meanwhile, ordinary workers and families carried crushing losses. Go back to Latvia and the picture sharpens again. Yes, the economy recovered, but a quarter of output vanished at the trough. Public wages were slashed. Unemployment passed 21%. Many people solved the crisis the only way they could. They left. That is another hidden cost history often understates. A crisis can balance the books on paper while emptying a country of years, confidence, births, trust, and future citizens. It can look cleaner in a spreadsheet than it feels in a schoolyard. Who walks away fine, or at least less damaged, usually those with assets abroad, those with low debt, those whose income comes in foreign currency, those in export sectors when devaluation makes their goods cheaper to outsiders, those with political access, those who understand the system early enough to step aside before the ceiling falls. In Iceland, exporters gained from the weaker krona. Tourism later exploded. Fish and aluminum became more competitive. The trade balance improved sharply. A WTO summary noted that Iceland's goods and services trade balance moved from a deficit equal to 5.7% of GDP in 2007 to a surplus of 12.3% in 2011. That is what a devaluation can do. It is not magic. It is redistribution through prices. It hurts consumers of imports, but it helps producers who sell to the outside world. In a crisis, one side of the economy gets heavier, while the other suddenly finds more wind in its sails. The question is not whether that is fair in every case. The question is whether it is less destructive than making unemployment and debt servitude do all the adjustment alone. The historical record shows that those who came through this period largely shared three characteristics. They had some form of buffer, they had flexibility, and they understood that the old price of things would not hold. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. A buffer can mean many things in history. It can mean cash. It can mean low debt. It can mean a job linked to exports rather than domestic credit bubbles. It can mean a family network strong enough to absorb temporary shocks. The point is not wealth in the glamorous sense. It is distance from forced selling, forced borrowing, and forced panic. In Iceland, some of the relative winners were not flashy financiers at all. They were firms tied to exports, fishing, and later tourism. When the krona weakened, Iceland suddenly looked cheaper to the rest of the world. A hotel room, a whale-watching trip, a plate of cod, an aluminum shipment, all of it became more competitive. It was as if the island had been standing in a harsh wind for years, and then the wind changed direction. The same gust that knocked over consumers of imports began pushing exporters forward. That is one reason the recovery surprised people. Many outside observers looked only at the crash of the banks and the currency. They did not look closely enough at what a cheaper currency and a contained banking system could do for the tradable side of the economy, which means the parts that sell beyond the country's borders. Flexibility matters because crises break rigid people first. Workers who could switch sectors, firms that could adjust costs, and states that still controlled key policy tools all had a better chance. Iceland had this flexibility because it still had its own currency, its own capital account rules, and the political will to use emergency powers. Greece had far less. Latvia chose to limit its flexibility in order to defend its peg. That choice shaped the human cost. And then there is the third trait: recognition. The survivors in historical crises usually grasp one thing earlier than everyone else. The boom is over, and the numbers printed during the boom are ghosts. House prices, exchange rates, bank valuations, growth forecasts. Many of them are memories pretending to be facts. The people who survive best do not keep negotiating with ghosts. In Iceland's case, the state eventually accepted that the giant banks, as they had existed, were finished. It did not spend endless years insisting the old structure would come back if only people were patient. That matters. Denial is expensive. It turns a crisis from surgery into infection. Another group that mattered in Iceland was the political public itself. Citizens did not quietly absorb every demand made in the name of international respectability. They protested. They voted. They forced the question of who owed what to whom. That is a deeply underrated part of the recovery. Democracy did not remove the pain, but it stopped one version of the pain from being sealed in concrete. The same is true in reverse in many other crises. Where the public is told there is no alternative, there is usually an alternative. It may be costly, it may be messy. But the phrase "no alternative" often means no alternative that protects both society and creditors at the same time. And that brings us back to our teacher in Reykjavik. In the months after the crash, her life does not become easy. Her grocery bill rises, her mortgage feels unstable. The news is a permanent storm cloud. Friends worry about jobs. Trust in leaders breaks. The country feels smaller and more exposed than it did during the boom, as if someone had pulled away the painted backdrop and revealed the cold ocean behind it. But the worst fear does not fully come true. The schools stay open. The payment system functions. The entire welfare model is not smashed apart. The country does not spend a decade trapped in the same pose of apology. It bends sharply, painfully, but it does not snap. By the middle of the next decade, Iceland is no utopia. No crisis leaves a place untouched, but unemployment has fallen dramatically. The banking sector is smaller. Output has recovered. The state has regained room to breathe, and the lesson remains. Iceland recovered faster than expected, not because collapse is healthy, and not because pain is cleansing, and not because every outsider was wrong about everything. It recovered faster because when the moment of decision came, it refused the most socially destructive version of rescue. It protected the domestic core. It forced more losses onto creditors. It used capital controls as a shield, not as an ideology. It let the currency absorb part of the shock. It restructured. It accepted reality faster than many other crisis states. That is the part people miss. Recovery is not just about courage. It is about where the losses are allowed to land. And history, again and again, shows the same hard truth. If a country turns private financial excess into permanent public punishment, the crisis does not end when the panic ends. It moves into wages, pensions, taxes, migration, and time itself. If it contains the blast, shares the losses more widely, and preserves the basic machinery of daily life, the wound can close sooner. Not cleanly, not perfectly, but sooner. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.